Hi, my name is Jim and I was retired. Should you retire your mortgage before you retire, when you retire, or after you retire? Stay tuned to this video for my thoughts on when retirees should pay off the mortgage. Do you want to start an argument on the internet? Venture the idea that you should pay off your mortgage before retirement. There are a lot of people out there with very low interest mortgage loans who say, I'm going to use the cash flow for more lucrative investments. I don't know how many people fall for that argument, but I was reading Fritz Gilbert of the Retirement Manifesto fame recently, and he published some fascinating statistics about retirement, including this one. Let me show you. So among these fascinating retirement statistics was this one. Down here, retirement readiness, 51% of baby boomers are still paying off their mortgage in retirement, and 40% struggle to pay off their credit card debt. 51%? More than half? That seems a little high. He attributed it to legaljobs.com, and so I went over there to see if there was a better source of information here. And sure enough, here are some statistics from this website, including this one down here under Baby Boomer Retirement Statistics. Number 27, 51% of baby boomers are still paying their mortgage in retirement. U.S. retirement statistics are a bit dire for many baby boomers, with just over half of them having to make monthly mortgage payments in retirement, with the average monthly homeownership cost of about $1,200 a month. Now, this is not sourced either, though. So I'm still struggling. Is this an accurate figure? I Googled to see if I could find at least backup for this factoid or a better factoid supported by some research. For instance, this white paper by the Center for Retirement Research at Boston College includes some information about financial security at older ages. And it tells a slightly different story. While this report notes that consumers ages 50 and older are decreasingly indebted since the Great Recession, the researchers do cite an increase in indebtedness among those adults ages 70 and older, due primarily to mortgages. Page 15 includes this paragraph. Figures 4A through 4G examine age-related trends in sources of debt and how they have changed between 2010 and 2019. As expected, the share of older adults with mortgage debt declined with age in both years. However, the trend lines cross at age 70. Thus, adults ages 50 to 69 are less likely to carry a mortgage debt in 2019 than they were in 2010. And the difference is substantial. For example, 46.6% of the 50-year-olds had mortgages in 2010 compared to only 39.8% in 2019. That sounds like less people are entering retirement with a mortgage. It does say that adults ages 70 and older are more likely to have mortgage debt in 2019 compared to 2010, but let's go to that graphic. So here is that chart that the researchers were talking about, and it includes two lines, a blue line and a red line. The blue line is 2010, and it notes that the age of the participants are along the bottom, and the percentage with mortgage debt is along the side. And if you see, the blue line in 2010 began above 45% for the young cohort and fell to below 10% for the oldest cohort. And then in the red line, their most recent version of this result, in 2019, the youngest cohort in age 50, it's just about 40%, and it falls to, again, close to 8% or so for the oldest cohort. And look where the line crosses at about 33% at age 70. And yes, indeed, the red line is above the blue line, but not by much. And again, this scale is 0 to 50%, not the 51% of that other statistic. So what is the story? The Squared Away blog, also from the Center for Retirement Research at Boston College, notes that boomers have been repairing their mortgage finances in recent years. I've zoomed in a little bit on the top of this summary of their results and says the housing market collapse more than a decade ago inflicted a lot of financial damage on baby boomers nearing retirement. But a new study finds that some have been trying to make up for lost time by rapidly reducing their mortgage debt. And down here it says they have also fallen behind in fully paying off their mortgages, which would eliminate their monthly payments and make the house a low-cost place to live in retirement. Just a half of the boomers born in the early 1950s who have held on to their homes during the Great Recession own them outright. 2/3 of the people born in the early 1930s had paid off their mortgages by that age. Maybe the 51% is for the younger baby boomers that retire with a mortgage. I don't know. But I think the trend is the older you get, the less debt you want on your balance sheet. And this concludes with, however, the share of boomer households that have paid off their mortgages has increased recently as boomers have stepped up their efforts to reduce debt. So maybe it's just peaking out here and we'll go back to more traditional levels of entering retirement without a mortgage if you can. I actually jumped to this Jason Fichtner research at Johns Hopkins University, and let me take you there. Now, this guy has done some research on home ownership and housing debt in retirement and tries to figure out whether it's a financial asset for consumption smoothing or an albatross around the neck of retirees. Again, I'm trying to figure that out too. So let me jump to some of the highlights of this white paper. So it begins with a literature review in the white paper, and let me just start there by scanning it quickly with you. It begins with Michelle Singletary of the Washington Post talking about how her grandmother, Big Mama, had longed for the day she wouldn't have a mortgage albatross around her neck, and I think all of us do. And it did note that 37% of U.S. homes no longer have a mortgage attached to them. The share of households headed by someone older than 65 that have no mortgage has increased from 32% in 2009 to 38% in 2017. Again, not yet up to that 51%. It does say that currently more than 9 million households aged 65 and older have mortgage debt. So there's some percentage of people who do carry mortgages into retirement. Down here it says an increasing share of homeowners aged 65 and older are now carrying some type of home debt. And the other question I have is how much of this is the original mortgage and how much is HELOC? Because there is a strategy of having a HELOC into retirement, but not having the original mortgage. So I'm not sure. His research looks at different age cohorts in this study of data. And again, it's a representative random sampling of financial data that he's been using here. And it does know that the home ownership rates in all cohorts declined after the Great Recession. So again, some people lost their homes in the Great Recession. The decline in home ownership rates was more pronounced in the younger cohorts, those born 1956 to 1960, exhibiting approximately a 17% rate drop in home ownership immediately following the Great Recession. For those born 36 to 40, home ownership declined only slightly in the 2 years after the Great Recession. Second, he says, as of the 2016 survey, home ownership for each cohort remained below its pre-Great Recession level. Third, comparing the birth year cohorts at a specific average age is also illuminating. Both the 1956 to 60 cohort and 51 to 55 cohorts exhibit less home ownership than the older three cohorts. Fourth, as you might expect, as cohorts get older, home ownership rates decline as the elderly move out of their homes and potentially into assisted living. Here's that chart he was just talking about, home ownership rates by birth year. And I'll let you go through it in detail. I'll put a link to all of these white papers I found in the notes below. But here's the key part of the study for me. In this next figure I'm going to show you, it shows the percentage of households that own their primary home and have paid off their mortgage. And that generally increases steadily with age. And it does note that while the older cohorts all exhibit this in a greater trend, the younger ones are catching up. Now this chart takes a little bit of explaining. The blocks represent 2008, the Great Recession, to show you where people were. And each line, each color line is a different cohort. The dark blue is the oldest. The green is the youngest cohort. Now, two of these younger cohorts I think bear looking at. One is the blue line of those that are just slightly older than I am and who are retiring at normal retirement ages now. And if you look at this, the block represents 2008. And this represents the last part of the study, the last study years. And it's just over 50% that have paid off their mortgage. The green line represents my cohort. In 2008, only about a third of them had paid off their mortgage. Luckily, I was one of them. But now it's a little over 40-some% that have paid off their mortgage. So I've jumped down to pages 26 and 27 now in his white paper, and I'll just leave you with some of the conclusions and discussions. And he talks about whether or not homeownership and housing debt in retirement is an asset or an albatross is a more nuanced answer than yes or no. And as this study shows that while a percentage of homeowners paying off their mortgage before retiring has declined with each new birth year cohort, most retirees that own a home still tend to pay off the mortgage as they get older. And so therefore it suggests that it's not going to actually be the catastrophe that some people suggest. He does also raise the presence of HELOCs in retirees, and he concludes with this: similar to the narrative about whether a retirement crisis looms on the horizon, the narrative that a home debt-related retirement crisis is brewing because more homeowners are entering retirement with debt is too binary. He also knows while some homeowners are indeed over-leveraged, the literature suggests that it's high credit card debt that causes more financial distress rather than home-related debt. I'm going to conclude with this part of section here where he talks about a mortgage in retirement could expose a retiree on a fixed income to financial stress later in life if the increasing share of the monthly Social Security retirement benefit, for instance, is required to make the monthly mortgage payment. If you're taking out a mortgage at 65, you won't be paying that 30-year mortgage off until 95. And given that the story of home debt in retirement is more complicated and nuanced than is often portrayed in the popular press, further research needs to be done. But he does point out that there are advantages and disadvantages. So do I think more than half of baby boomers are entering retirement with a mortgage? I'm not sure. But I do know there are very valid reasons why you'd want to get that done and retire the mortgage before you retire. I believe in most cases, retiring the mortgage before you retire or are forced to retire is a better idea. In my personal experience, retiring the mortgage in my early 50s allowed me to do the catch-up contributions to retirement savings and again max out those savings. That put me in a much better position when I was age 59 and suddenly found out that I was retired. In my experience, retiring the mortgage in your late 40s or early 50s will allow you to use that cash flow to max out retirement savings in an IRA or 401k. Both allow catch-up contributions after the age of 50, and that will put you in a much better position if retirement comes sooner than you expected, or if it comes when you expect it. I'm going to put a couple links to some other popular press articles about paying off your mortgage before retirement, or at retirement, or in retirement. And again, I want to suggest that the only really bad idea out there is paying it off at retirement with your retirement savings. Why would you want to run that money out of a tax-deferred account, declare it as ordinary income, pay your tax to Uncle Sam, and then retire the dead? Not a smart move. If you're entering retirement with a mortgage, think out a strategic way to do that. You might want to do it over a period of years. You might want to use a catch-up mortgage payment as part of your retirement budget. You might want to see if you can take a fixed income source like an annuity or a pension or a dividend income source and allocate that to retiring the mortgage early in your retirement. Now, if you do retire and at retirement you have fixed income in taxable accounts, cash in the bank or bonds in a taxable account, and they're earning less than what you would be paying your mortgage rate, then by all means use that to pay off the mortgage. But you want to do that as your budget allows. Make sure you continue to hold that cash cushion for the first few years of your retirement, for instance. Don't make the assumption that you can use the cash flow to invest in equity. A mortgage is a fixed income form of investment. So compare your mortgage rate with the rates you would get from a stable fixed income investment like a CD or a municipal bond or a high-grade corporate bond. Don't compare it to what you might get on your equity. Now, if you're entering retirement with a mortgage, one thing you might consider is to build it into your asset allocation. And when you rebalance with too much equity and you want to invest into fixed income, maybe you make an extra payment to the mortgage and treat that as part of your asset allocation over the first few years of your retirement. Again, the sooner you can get rid of the mortgage, the more stable your budget's going to be and the less stress you'll have later in retirement. Some also keep a mortgage because they believe that they can deduct the mortgage interest. Well, with the large standard deductions, so few people itemize anymore. And even if you do, each year goes by, that interest portion of the mortgage payment becomes smaller and smaller. So again, I think most people want to retire that mortgage as quickly as they can if they brought it into retirement with them. Hey, one final thought is I've seen some questions about using Roth to pay off your mortgage. Again, my asset allocation means I'm putting equity investments in the Roth. And I don't want to trade equity investments for a fixed income investment. Now, if you have too much in your Roth and you want to be free of the mortgage, that's another source. At least you won't have to pay Uncle Sam taxes by taking money out of the Roth to pay off the mortgage. But I think a smarter move might be to build it into your schedule of payments early in retirement. By the way, I am not an accountant. I am not a financial planner. So take this as entertaining ideas from one educated consumer to another. Always do your own due diligence and seek out a professional if you need to. And don't fall for statistics in the popular press without finding out whether they're right. Be sure to like and subscribe to this channel. The more thumbs up and subscriptions, the higher this will be in the YouTube search. So please do me a favor, hit the like, hit subscribe. Thanks.